Comprehensive Financial Analysis and Options Swing Trading Strategy for SPDR Portfolio S&P 500 ETF, SPYM. Executive Summary. The SPDR Portfolio S&P 500 ETF, SPYM, has rapidly emerged as the premier low-cost alternative to the SPDR S&P 500 ETF Trust, SPY, for investors seeking S&P 500 exposure under $100 per share. Backed by State Street, SPYM offers a rock-bottom 0.02% expense ratio, robust tracking of the S&P 500, and a structure optimized for long-term, cost-conscious investors. This report provides a thorough financial analysis of SPYM, including its structure, performance, expense ratio, liquidity, and a detailed comparison to SPY. It then develops a research-backed swing trading option strategy tailored for small accounts, with actionable recommendations for contract selection, risk management, and broker execution. 1. SPYM, Fund Structure, Issuer, and Core Characteristics. 1.1 Fund Overview and Issuer Details. SPYM is an exchange-traded fund, ETF, managed by State Street Global Advisors, one of the world's largest and most reputable asset managers. Launched in November 2005, SPYM seeks to replicate the total return performance of the S&P 500 index, which represents approximately 80% of the U.S. equity market by capitalization. The fund is structured as an open-end ETF, providing flexibility for dividend reinvestment and securities lending, features that distinguish it from the Unit Investment Trust, UIT, structure of SPY. SPYM's open-end structure allows for efficient cash management, automatic dividend reinvestment, and the ability to lend securities for incremental income. These operational efficiencies contribute to its ultra-low expense ratio and minimal tracking error. Key fund facts. Issuer, State Street Global Advisors. Inception date, November 8, 2005. Structure, open-end ETF. Benchmark, S&P 500 Index. Expense ratio, 0.02%. Assets under management, AUM $106 billion, as of February 2026. Share price, $81, as of February 2026. Dividend yield, 1.12%, paid quarterly. Number of holdings, 504 to 506. Replication method, full replication, holds all S&P 500 constituents. 1.2 Holdings in sector allocation. SPYM holds every stock in the S&P 500, weighted by market capitalization. Its top 10 holdings mirror the index and include the largest U.S. companies, such as Nvidia, Apple, Microsoft, Amazon, Alphabet, Broadcom, Meta Platforms, Tesla, and Berkshire Hathaway. The top 10 represent approximately 37 to 39% of total assets, reflecting the current concentration in megacap technology and growth stocks. Sector allocation, as of February 2026. Information technology, 35%. Financials, 13%. Communication services, 11%. Consumer discretionary, 10%. Healthcare, 9.6%. Industrials, 8.9%. Consumer staples, 5.3%. Energy, 3.3%. Utilities, 2.3%. Materials, 2%. Real estate, 1.9%. This sector breakdown is virtually identical to SPY, ensuring that SPYM delivers the same economic exposure and risk profile as its higher-priced counterpart. 2. Expense ratio and fee comparison, SPYM versus SPY versus VO. 2.1 Expense ratios, the compounding advantage. SPYM's defining feature is its ultra-low expense ratio of 0.02%, which is the lowest among major S&P 500 ETFs. In comparison, SPY, 0.0945%, UIT structure. VO, Vanguard S&P 500 ETF 0.03%, open-end ETF. Table, S&P 500 ETF expense ratios and accessibility. Sources, State Street, Vanguard, ETF Savant, A-Invest, ETFDB, Stock Analysis, Yahoo Finance. Analysis. While the difference between 0.02% and 0.09% may seem trivial, the compounding effect over decades is substantial. For example, on a $10,000 investment, the annual fee gap between SPY and SPYM is $7. Over 30 years, assuming a 7% annual return and monthly contributions, this can result in a portfolio value difference of $16,000 to $90,000 in favor of SPYM. 2.2 Fee impact on long-term returns. The lower expense ratio directly translates into higher net returns for investors, especially for buy and hold and dollar-cost averaging strategies. This is particularly advantageous for small accounts, where every basis point saved is meaningful. 3. Performance and tracking error. 3.1 Historical performance. SPYM's performance is virtually indistinguishable from SPY and VOO, as all three track the same S&P 500 index using full replication. Over the past decade, the annualized returns for SPYM and SPY have been within a few basis points of each other. Table: SPYM versus SPY performance, as of Jan/February 2026. Sources: State Street, Vanguard, Morningstar, Finance Charts, Yahoo Finance. Analysis. The minuscule differences in returns are attributable to the slightly lower expense ratio and more efficient dividend reinvestment in SPYM's open-end structure. Over long periods, SPYM may even slightly outperform SPY due to these structural advantages. 3.2 Tracking error. SPYM's tracking error versus the S&P 500 index is extremely low, typically less than 0.05% annually. This is achieved through full replication and efficient portfolio management. The open-end structure allows for continuous rebalancing and reinvestment of dividends, further minimizing tracking error compared to SPY's UIT structure, which cannot reinvest dividends. 4. Liquidity and trading volume analysis. 4.1 Trading volume and bid-ask spreads. SPY is the world's most liquid ETF, with average daily trading volume exceeding $52 to $74 billion in bid-ask spreads as tight as 0.005%, about 1 cent per share. SPYM, while less liquid, still boasts robust trading volume averaging 9 to 10 million shares daily and a bid-ask spread of about 1 cent, 0.016% in percentage terms. Table: Liquidity metrics. Analysis. For most retail investors and swing traders, SPYM's liquidity is more than sufficient. However, for institutional traders or those executing very large orders, SPY's deeper liquidity may offer marginally better execution, especially during periods of market stress. 4.2 Slippage and execution. Bid-ask spreads and slippage are critical for options traders. SPYM's spreads are slightly wider in percentage terms than SPY, but still tight enough for efficient execution. Using limit orders and trading during regular market hours can further minimize slippage. 5. Replication methodology and holdings. SPYM uses full replication, holding all 500-plus stocks in the S&P 500 index in their exact market cap weights. This approach ensures minimal tracking error and maximum transparency. The fund's top holdings and sector allocations are nearly identical to SPY and VOO. Top 10 holdings, February 2026. 1. Nvidia Corp., 7.19%. 2. Apple Inc., 7.02%. 3. Microsoft Corp., 5.04%. 4. Amazon.com Inc., 3.73%. 5. Alphabet Inc. Class A, 3.32%. 6. Alphabet Inc. Class C, 2.65%. 7. Broadcom Inc., 2.52%. 8. Meta Platforms Inc., 2.51%. 9. Tesla Inc., 1.92%. 10. Berkshire Hathaway Inc., 1.59%. 6. Dividend policy and tax treatment. 6.1 Dividend yield and distribution. SPYM pays dividends quarterly, with a current yield of approximately 1.12%, slightly higher than SPY and VOO due to efficient reinvestment and lower fees. The fund's open-end structure allows for immediate reinvestment of dividends, maximizing compounding. Recent dividend payments, 2025. DEC, $0.23818 per share. SEP, $0.23823 per share. June, $0.21361 per share. MAR, $0.21741 per share. 6.2 Tax treatment. SPYM's dividends are generally classified as qualified dividends, eligible for favorable long-term capital gains tax rates for U.S. investors, provided holding period requirements are met. The ETF structure also enables in-kind redemptions, minimizing capital gains distributions and enhancing tax efficiency. 7. Why SPYM is the closest low-cost alternative to SPY under $100. 7.1 Accessibility and dollar cost averaging. SPYM's share price, $690, and VO, $600, enabling more flexible position sizing and easier dollar cost averaging. 7.2 Cost efficiency and long-term compounding. The 0.02% expense ratio is the lowest among major S&P 500 ETFs, maximizing long-term compounding for buy-and-hold investors. Over decades, this cost advantage can translate into thousands of dollars in additional returns, especially for small accounts. 7.3 Institutional backing and credibility. SPYM is managed by State Street, the same issuer as SPY, ensuring institutional-grade oversight, transparency, and operational robustness. This makes SPYM a credible, reliable core holding for both retail and institutional investors. 8. Risks and drawbacks of using SPYM instead of SPY. 8.1 Liquidity premium. SPY's unmatched liquidity and options market depth make it the preferred vehicle for high-frequency traders, large institutions, and those executing complex options strategies. While SPYM's liquidity is ample for most retail traders, it may not match SPY's efficiency for very large or rapid trades. 8.2 Behavioral inertia. Many investors default to SPY or VO out of familiarity, despite higher fees. This behavioral inertia can slow the adoption of SPYM, potentially limiting its liquidity growth relative to SPY. 8.3 Tracking error in extreme markets. During periods of extreme market stress, less liquid ETFs can experience wider bid-ask spreads and temporary tracking error. However, SPYM's structure and scale mitigate most of these risks for typical account sizes. 9. Options market for SPYM, availability and liquidity. 9.1 Options availability. SPYM offers listed options with multiple expiration dates, weeklies, monthlies, and leaps, similar to SPY. The options market for SPYM is active, with open interest and trading volume concentrated around at the money and near the money strikes, especially for expirations 30 to 60 days out. Sample option chain, March 20, 2026 expiration. $81 call, open interest 465, volume 3. $80 call, open interest 115, volume 3. $80 put, open interest 51, volume 10. $78 put, open interest 71, volume 2. 9.2 Liquidity and bid-ask spreads. While SPYM options are less liquid than SPYs, they are sufficiently active for small to medium-sized trades. Bid-ask spreads are generally 5 to 10 cents for at-the-money strikes, widening for deep and out-of-the-money contracts. For most swing trading strategies, this liquidity is adequate, especially when using limit orders. 10. Technical analysis indicators for swing trading SPYM. 10.1 Core technical indicators. Successful swing trading in SPYM options relies on a blend of trend, momentum, and volatility indicators. The most effective and widely validated indicators for swing trading SPYM include moving averages, MA 20-day and 50-day EMAs for trend direction and support/resistance. Relative Strength Index, RSI 14 period for overbought/oversold signals and divergence. MACD, Moving Average Convergence Divergence 12, 26, 9 settings for momentum shifts and crossovers. Bollinger Bands, 20 period for volatility breakouts and mean reversion. Volume, confirmation of breakouts and trend strength. Support and resistance levels, key price zones for entries and exits. Table, top technical indicators for SPYM swing trading. Analysis. Combining 2 to 3 complementary indicators, e.g., trend plus momentum plus volume, increases signal reliability and reduces false positives. For SPYM, daily charts are optimal for swing trades lasting 2 to 10 days. 11. Option strategies for small accounts, swing trading SPYM. 11.1 Strategy selection criteria. Small accounts, less than $10,000, require strategies that are Defined risk, maximum loss is known upfront. Capital efficient, low margin requirements. Theta resilient, manageable time decay. Liquid, easy to enter/exit with minimal slippage. Scalable, adaptable as account grows. 11.2 Recommended strategies. At debit spreads, vertical spreads. Bull call spread, buy ATM/near ATM call, sell OTM call, same expiration. Bear put spread, buy ATM/near ATM put, sell OTM put, same expiration. Advantages. Defined risk and reward. Lower cost than naked long options. Capital efficiency, ideal for accounts less than $5,000. Less sensitive to rapid theta decay than naked options. B. Credit spreads, vertical spreads. Bull put spread, sell OTM put, buy further OTM put, same expiration. Bear call spread, sell OTM call, buy further OTM call, same expiration. Advantages. Defined risk and reward. Collect premium upfront. High probability of profit if strikes are chosen wisely. Can be managed/closed early for partial profit. C. Long calls/puts, directional. Buy ATM or slightly ITM call/put for directional swing trades. Higher risk of theta decay, best for short holding periods and strong conviction. D. Diagonal spreads. Buy longer dated ITM/ATM option, sell shorter dated OTM option. Benefit from time decay on short leg and directional move on long leg. E. The wheel strategy, for larger accounts. Sell cash secured puts, if assigned, sell covered calls. Requires capital to buy 100 shares, best for accounts greater than $8,000. 12. Greeks and contract selection guidance for SPYM options. 12.1 Understanding the Greeks. Delta measures sensitivity to underlying price changes. For calls, delta ranges from 0 to +1, for puts, from 0 to -1. A 0.50 delta option moves 50 cents for every $1 move in SPYM. Gamma measures the rate of change of delta. Highest for ATM options. Theta measures time decay. Highest, most negative, for ATM options close to expiration. Vega measures sensitivity to implied volatility. Higher for longer dated ATM options. Contract selection guidelines. Delta, for directional trades, select options with delta 0.40 to 0.60, ATM or slightly ITM, for a balance of price sensitivity and time decay. Theta, avoid contracts with less than 7 days to expiration unless selling premium. For debit spreads, 21 to 45 DTE is optimal. Liquidity, choose strikes with high open interest and volume, typically ATM and 1/2 strikes OTM. Bid-ask spread, prefer contracts with spreads less than 10 cents for efficient execution. 13. Position sizing and risk management for small accounts. 13.1 Position sizing rules. Risk per trade, limit to 1 to 2% of total account value. Maximum open positions, 3 to 5 for accounts less than $5,000. Fixed fractional method, allocate a fixed percentage of capital per trade, adjust as account grows. Kelly criterion, fractional for advanced users, use 1/2 or 1/4 Kelly to balance growth and drawdown risk. Example. For a $2,000 account, risk $20 to $40 per trade. If a debit spread costs $100, this is 5% of the account, too high. Instead, use $50 spreads or trade fewer contracts. 13.2 Stop loss and exit criteria. Stop loss, set at 50% of premium paid, for debit spreads, or 2x premium received, for credit spreads. Profit target, 50 to 75% of maximum profit. Time-based exit, close positions with less than 7 days to expiration to avoid rapid theta decay. Diversification, avoid overconcentration in one direction or sector. 14. Recommended SPYM options contracts by account size. Table, SPYM options contract recommendations by account size, March 2026, SPYM $81. Asterisk notes. All examples use March 20, 2026 expiration. Adjust strikes to maintain risk per trade at 1 to 2% of account. Select contracts with open interest greater than 100 for liquidity. Use limit orders to minimize slippage. Analysis. For accounts less than $1,000, stick to single contract debit or credit spreads with narrow widths, $2 to $3. For $1,000 to $5,000, scale up to 2 to 3 contracts or slightly wider spreads. For $5,000 to $10,000, diversify across multiple strikes and expirations, but never risk more than 2% per trade. 15. Backtesting and historical performance of proposed strategies. 15.1 Absolute Momentum Long-Only Strategy, SPYM. A backtest of a simple momentum strategy, long SPYM, when 252-day rate of change 0 and price greater than 200-day SMA, exit on close less than 200-day SMA or after 20 days, or at plus 8% TP/a 4% SL, produced the following results, 2024 to 2026. Sources: A Invest News, ETF Savant. Analysis. While the annualized return is modest, the strategy demonstrates positive expectancy and manageable drawdowns. Option strategies, debit/credit spreads, layered on top of these signals can further enhance returns, especially when using technical confirmation, e.g., RSI, MACD crossovers. 15.2 Options Backtests. Backtests of 30 to 45 DTE put credit spreads on SPY, proxy for SPYM, show win rates of 85 to 93% for 0.30 delta short puts. Sharp ratios improve when using 50% profit targets and closing at 15 to 21 DTE. Lower position sizes, 5% of capital, reduce drawdowns and volatility. 16. Execution considerations and broker selection. 16.1 Execution best practices. Use limit orders, avoid market orders to minimize slippage, especially in less liquid contracts. Trade during regular hours, liquidity is highest and spreads are tightest. Monitor open interest, choose strikes with greater than 100 open interest for easier entry/exit. Avoid trading near major news events, volatility can widen spreads and increase slippage. 16.2 Broker selection for small accounts. Top brokers for options trading, 2026. Sources: NerdWallet, BrokerChooser, Brokerage Review. Analysis. For small accounts, zero-commission brokers like Webull, Robinhood, and Firstrade maximize capital efficiency. For advanced analytics and execution, Fidelity, Schwab, and Interactive Brokers are top choices. Always verify that your broker supports multi-leg option strategies and provides real-time Greeks and analytics. 17. Summary Table, SPYM versus SPY. Sources: ETF Savant, InvestLane, State Street, ETFDB, Stock Analysis, Yahoo Finance. 18. Conclusion: the case for SPYM and a disciplined option swing trading approach. SPYM stands as the closest, most cost-effective alternative to SPY for investors and traders seeking S&P 500 exposure under $100 per share. Its 0.02% expense ratio, robust tracking, and open-end structure deliver maximum compounding and operational efficiency. While SPY remains the liquidity king for institutional and high-frequency traders, SPYM's liquidity is more than sufficient for most retail investors and swing traders. For small accounts, defined risk option strategies such as debit and credit spreads offer the best blend of capital efficiency, risk control, and profit potential. By combining robust technical analysis, moving averages, RSI, MACD volume, with disciplined position sizing, 1 to 2% risk per trade, traders can swing trade SPYM options with confidence. Broker selection should prioritize low fees, platform reliability, and support for multi-leg strategies. Key takeaways. SPYM is the optimal low-cost S&P 500 ETF for accounts under $100 per share, maximizing long-term returns through fee minimization. Option swing trading on SPYM is viable for small accounts using debit/credit spreads, with careful attention to liquidity, Greeks, and risk management. Position sizing, disciplined exits, and broker selection are critical for sustainable success. By adhering to these principles and leveraging the structural advantages of SPYM, investors and traders can build resilient, cost-efficient portfolios and trading strategies that stand the test of time. Comparative Financial Review, 2 times leveraged S&P 500 ETFs, ProShares Ultra S&P 500, SSO, versus Direct and Daily S&P 500 Bull 2 times, SPUU. Both SSO and SPUU are 2 times leveraged ETFs tied to the S&P 500, aiming to double the index's daily return, or loss, before fees. However, they differ in size, cost, and liquidity. SSO, launched 2006, is the largest and most liquid 2 times S&P 500 ETF, with about $7 to $8 billion in assets and 4 to 5 million shares in average daily trading volume. SPUU, launched 2014, is much smaller at roughly $0.25 to $0.3 billion AUM and trades only around 20 to 30,000 shares daily, implying wider bid-ask spreads. SSO's expense ratio, 0.87 to 0.90%, is higher than SPUU's, 0.60%, reflecting its different approach and larger scale. In practice, both funds fulfill their mandate of 2 times daily S&P 500 exposure. In strong bull markets, they can significantly outperform the index, but in volatile or adverse markets, they can underperform expectations due to volatility decay. Below, we provide a detailed, data-driven comparison of SSO versus SPUU across key dimensions, followed by strategic considerations for using these high-octane products. Portfolioslab.com, tickeron.com, swingtradebot.com, besttf.net, nasdaq.com. 1. Fund objectives and structure. ProShares SSO and Directs and SPUU are both leveraged index ETFs that seek to deliver plus 200% of the S&P 500's daily return, and minus 200% on the downside, before fees and expenses. Each morning, the fund managers reset exposure to maintain 2:1 leverage relative to the index's value. This daily resetting is pivotal. It ensures 2 times daily performance, whether the S&P 500 goes up or down, but also means longer-term returns can deviate from exactly 2 times the index's cumulative change due to compounding effects, discussed further in Section 4. Portfolioslab.com, ETF.com. SSO, ProShares Ultra S&P 500 launched in June 2006. SSO was one of the first leveraged ETFs. It is passively managed to track 2 times the S&P 500's daily moves. Under the hood, SSO employs a synthetic replication strategy, meaning it primarily uses derivatives, total return swaps with multiple large banks, plus E-mini S&P futures, to obtain double exposure, while holding large positions in cash or treasuries as collateral. For example, as of January 2026, SSO's top holdings were a series of S&P 500 swap contracts with banks like Goldman Sachs, JP Morgan, Barclays, etc., and S&P 500 E-mini futures. By using swaps and futures, SSO can efficiently increase its market exposure to 200% of its net assets without directly owning all the index stocks. This structure gives SSO flexibility and high liquidity, but the fund's reliance on derivatives contributes to slightly higher management costs, expense ratio 0.89%, and introduces counterparty risk, the risk that a swap counterparty could default, which SSO mitigates through collateral and diversification of counterparties. Portfolioslab.com, seekingalpha.com, besttf.net. SPUU, Directs and Daily S&P 500 Bull 2 times launched in May 2014 as a competitor to SSO. SPUU also targets 2 times the S&P 500's daily return. Unlike SSO, SPUU uses a hybrid strategy. It holds a substantial portion of the actual S&P 500 stocks, 500 plus holdings, and then uses a smaller amount of derivatives to achieve the full 2 times leverage. For instance, as of January 2026, over 98% of SPUU's portfolio was invested in the S&P 500 constituents, top holdings like Apple, Microsoft, Nvidia, Amazon, etc., with a small allocation, 1 to 2%, to an S&P 500 index swap contract to provide the additional exposure. This partial synthetic, partial physical approach results in a lower expense ratio of 0.60%, since holding stocks is cheaper than financing total return swaps. However, SPUU's smaller asset base and trading volume, Section 2, can make large trades more challenging. Investors may need to be mindful of liquidity and potentially wider bid/ask spreads when trading SPUU, especially in volatile markets. Portfolioslab.com, besttf.net, besttf.net, realmoneymoves.com. Investment objective and behavior. Both funds are intended for short-term tactical use, not as components of a long-term buy and hold portfolio. They enable bullish investors to leverage the S&P 500's movements without using margin loans or complex derivative positions themselves. By resetting leverage daily, SSO and SPUU reliably produce approximately twice the S&P 500's one-day return, e.g. if the S&P 500 rises 1% in a session, these ETFs gain 2%, if it falls 1%, they lose 2%. This design ensures that new investors entering the fund obtain 2 times exposure from that point forward. However, daily compounding means that over multiple days the total return will not exactly equal 2 times the index's total return. It will depend on the path the market takes, discussed later in detail. In sum, SSO and SPUU share the same goal and fundamental mechanics, but differ in their scale, cost, and portfolio construction, as we elaborate below. ETFDB.com, WalletInvestor.com, ETF.com, WalletInvestor.com. 2. Key metrics: fees, AUM, liquidity, and tracking. Both SSO and SPUU give leveraged exposure to the same index, but their operational stats differ. Assets under management: fund size SSO is by far the larger fund, with approximately $7.5 to $8 billion AUM, making it the largest 2 times S&P 500 ETF. By contrast, SPUU is around $240 to $270 million AUM, roughly just 3 to 4% of SSO's size. In fact, SSO is 30 times bigger than SPUU, reflecting its earlier launch and much higher adoption by traders. BestTF.net, BestTF.net, Nasdaq.com. Expense ratios: SPUU's 0.6% annual fee is the lowest in the 2 times leverage category, undercutting SSO's 0.87 to 0.90% fee by about 0.27%. In other words, SSO's expenses are roughly 1.5 times those of SPUU, which can modestly hamper SSO's long-run returns. For perspective, both fees are orders of magnitude higher than fees on non-leveraged S&P 500 ETFs like SPY or VO, which typically charge 0.03 to 0.09%, due to the complexities of swaps, higher turnover, and financing costs in leveraged funds. BestTF.net. Liquidity and tradability: SSO's trading liquidity is exceptionally high, with an average daily volume around 3 to 5 million shares. Its bid-ask spreads are generally very tight, often just a penny, even for large orders. SPUU's volume is much lower, on the order of 20 to 30,000 shares per day, so investors face wider spreads and should use limit orders to trade it efficiently. During normal conditions, SPUU is still manageable for modest positions, but in fast-moving or volatile markets its liquidity can thin out, potentially increasing trading costs. SSO, in contrast, remains liquid even during volatility spikes, due to its large number of market participants. SwingTradeBot.com, RealMoneyMoves.com. Leverage and tracking accuracy: both funds use 2 times daily leverage and have delivered nearly identical performance over comparable periods, indicating that each tracks its 2 times mandate effectively. Beta, sensitivity to market moves, for both is about 2.0, twice the S&P 500's volatility. Their daily tracking error is minimal. By design they recalibrate every day to hit 200% of the S&P's performance. Over time, small differences can arise due to the fund's expense drag and compounding. For example, over the last 5 years SSO's total return slightly trailed SPUU's, about 20% versus 20.6% annualized, likely due to SSO's higher fee and the particular sequence of market returns. Over the past year, both funds delivered roughly plus 24 to 25% total return, versus 12% for the S&P 500, indicative of their successful leverage. Over 3 years, each achieved approximately plus 33% annualized, versus 16% for the S&P 500. In short, SPUU's lower expense ratio has given it a slight performance edge over longer horizons, but the difference has been very small. Both funds have come very close to the theoretical 2 times compounded performance of the S&P 500 over multi-year spans. BestTF.net, PortfoliosLab.com, PortfoliosLab.com. Dividends: neither fund is designed to provide significant income. Yields are very low, 0.51% annually, because the funds either hold no stock, in SSO's case, or only a small fraction of the stock dividends relative to their total exposure, in SPUU's case. Any dividends from stocks, or interest on cash collateral, are minimal relative to the amplified price moves. For instance, SPUU's distribution yield is around 1.6% versus SSO's 1.0%, reflecting SPUU's holding of the underlying stocks. Investors in these funds prioritize price returns, not yield. BestTF.net. Figure, SSO versus SPUU, key characteristics and risk metrics. Both ETFs exhibit similar risk/return profiles over extended periods. Notably, SSO's maximum historical drawdown was -84.7%, peak to trough during the 2008 financial crisis, whereas SPUU's worst decline was -59.3%, during the March 2020 pandemic crash. Daily volatility for each has been around 36 to 37%, roughly double the S&P 500's 18% over long periods. This 2x volatility is expected from a well-functioning 2x fund. Both funds therefore entail much higher risk in short-term swings than the unleveraged S&P 500, e.g. a 1% daily move in the index means 2% move in the 2x funds. Portfolioslab.com. 3. Historical performance, 1Y, 3Y, 5Y. Performance during different periods for SSO and SPUU has largely validated their 2x objective, but with notable impacts from volatility and compounding. Long-term growth, in bullish stretches, these 2x ETFs have magnified the S&P 500's gains. For example, over the 5-year period through early 2026, SSO delivered about plus 150% cumulative return, is almost equal to 20% CAGR, versus roughly plus 75%, is almost equal to 12% CAGR, for the S&P 500. SPUU, benefiting from slightly lower fees, ended a touch higher with 155% cumulative, is almost equal to 21% CAGR, in the same period. This outperformance illustrates how, in a trending bull market, a leveraged ETF can actually exceed 2x the index's total return, because the fund is effectively leveraging the compounded gains, earning 2x on each day's increase, which itself builds on prior gains. Portfolioslab.com, Portfolioslab.com, SeekingAlpha.com, SeekingAlpha.com. 1-year and 3-year trailing returns. More recently, both SSO and SPUU rose roughly plus 24 to 25% in the last 12 months, through early 2026, versus the S&P 500's 12% gain. Over the past 3 years, despite a volatile period that included a bear market in 2022, SSO and SPUU each earned on the order of plus 32 to 34% annualized, approximately plus 150% cumulative, while the S&P 500 earned 15 to 17% annualized, 50 to 60% cumulative. This again is close to the theoretical 2x outcome, which would be 30 to 34% annualized if the S&P 500 did 15 to 17%. Their strong 3-year performance was driven by the sharp rebound and sustained rally in 2020 to 2021 and into 2023, which outweighed the 2022 drawdown. Portfolioslab.com, Portfolioslab.com. Downside and bear market performance. In declining or volatile markets, the funds have shown the expected amplified losses, sometimes to an extreme. In calendar 2022, when the S&P 500 fell -18%, SSO dropped about -39%, roughly 2.1 times the index loss, and SPUU similarly about -39%. During the swift COVID-19 crash in Q1 2020, SSO and SPUU each lost well over 30% in a single month as the S&P 500 plunged. A 2x fund would have lost 60% when the index fell 30%, highlighting how quickly compounding can produce steep drawdowns. Over longer horizons, both funds have eventually recovered strongly in subsequent rallies. For example, SSO ended positive for full year 2020 despite the early crash, returning plus 21.5% versus the S&P's plus 18.4%. Still, the max drawdown figures underscore the risk. SSO has at one point lost nearly -85% of its value from peak to trough, late 2007 to 2009, and SPUU's worst plunge was of 59% in 2020. An investor holding SSO from October 2007 to early 2009 would have seen almost 5 years of gains erased. These episodes demonstrate that while the funds do multiply upside, they also multiply declines, and severe bear markets can lead to crushing losses, even if the funds live to fight another day. FinanceCharts.com, FinanceCharts.com, PortfoliosLab.com. Tracking differences. Aside from these effects of leverage, SSO and SPUU show very similar return profiles. There is no persistent performance gap beyond what's explained by their expense ratios and the small variations from compounding. In fact, for any reasonably short period, days or weeks, their returns are virtually indistinguishable, and even over years the total return difference is usually within a few tens of basis points. Both have done a credible job of delivering close to 2 times the S&P 500's performance over time, for better and worse. For volatility decay and beta slippage, impact on long-term returns. A critical aspect of 2 times ETFs is volatility decay, also known as beta slippage or volatility drag. This refers to the tendency for a leveraged fund's performance over time to be less, sometimes far less, than the simple 2 times, or 3 times, multiple of its index's cumulative return. The root cause is the mathematics of daily compounding in the presence of market volatility. In essence, path matters, up and down swings cause the geometric compounding of returns to fall short of the arithmetic sum of 2 times daily moves. ETF.com, ETF.com. Example, consider an index that rises plus 10% one day and falls minus 10% the next day. Over those 2 days, the index would go from 100 to 110, then drop to 99, for a total loss of minus 1%. A 2 times leveraged ETF would go from 100 to 120, plus 20%, then fall to about 96, minus 20% on the second day's lower base, ending with a minus 4% overall loss. In this scenario, instead of minus 2%, which is 2 times the index's minus 1% net move, the 2 times fund lost 4%, a larger magnitude of loss than expected. This shortfall is volatility decay in action. Essentially, whenever the underlying index zigzags, the fund levers each move and leaves the portfolio off its starting path, so it loses ground in choppy markets. WalletInvestor.com. Impact on long-term holdings. Because of volatility decay, holding SSO or SPUU for long periods, beyond a few days or weeks, can lead to returns that are much lower than 2 times the index's return, or even negative while the index is flat. In extreme cases, a leveraged ETF can lose value even if the underlying index ends up unchanged over the holding period, simply due to large up and down fluctuations. Asterisk: the more frequent and high amplitude the volatility, and the longer one holds the fund, the more pronounced the erosion of returns. For example, in the volatile year of 2011, the S&P 500 ended flat, 0% change, but a hypothetical 2 times S&P 500 fund would have lost value, due to several sharp reversals. Conversely, in a smoothly trending market, a leveraged fund can outperform its multiple. As noted earlier, in 2021's sustained rally, the S&P 500's 27% gain turned into 60% for SSO, slightly above the ideal plus 54%, 2 times, because there were few major whipsaws and gains were consistently compounded. The key lesson is that leveraged ETFs are extremely path-dependent. Long-term investors risk serious underperformance, or heavy losses, if the market is volatile or trends against them. WalletInvestor.com, ETF.com, WalletInvestor.com, WalletInvestor.com, FinanceCharts.com, FinanceCharts.com. Other factors: in addition to pure volatility math, the cost of leverage contributes to decay. Both SSO and SPUU incur financing and trading costs, from swaps, futures, rebalancing trades, etc., that gradually drag on performance. These costs are one reason leveraged ETFs have higher expense ratios and can slightly underperform their targets over time, even in low volatility conditions. Furthermore, in high volatility periods, frictional costs, wider spreads, swap spreads, etc., tend to rise, compounding the challenge. All these effects mean that investors should be extremely cautious about holding SSO or SPUU for extended durations. The ETF issuer ProShares itself warns that SSO should be avoided by those with a low risk tolerance or a buy and hold strategy, underscoring that these funds are unsuitable for long-term investments for most people. ETF.com, ETF.com, RealMoneyMoves.com, ETFDB.com. 5. Use cases and advantages of leveraged ETFs. Despite their risks, SSO and SPUU offer unique advantages for certain strategies and market conditions, primarily for knowledgeable traders with short-term horizons. Short-term tactical trades. The ideal use case for 2 times ETFs is short-term market speculation or hedging. Because they provide amplified daily moves, intraday trades or positions held for just a few days can capitalize on a market view without the need for direct leverage/margin accounts. For example, trading around major market events, earnings reports, economic data releases, Fed meetings, geopolitical developments, is a common strategy. If an investor expects a sharp near-term move up in the S&P 500, buying SSO/SPUU can double that move in the very short run. Similarly, if one has a high-conviction 1 to 3 day bullish view, these ETFs offer a straightforward way to express it with enhanced exposure.
RealMoneyMoves.com, RealMoneyMoves.com.
Capital efficiency, leverage without margin. Leveraged ETFs let investors gain more exposure with less capital, which can be useful for those who want to free up cash or avoid borrowing. For every $1 invested in SSO or SPUU, the fund provides about $2 of S&P 500 exposure. This means an investor could allocate half the capital to a 2x ETF to get the same notional market exposure as a full investment in an unleveraged S&P 500 fund. The unused capital could then be deployed elsewhere, or held in cash as a reserve. Importantly, using SSO/SPUU doesn't require maintaining a margin account or paying margin interest, as the leverage is embedded in the ETF structure. There are also no margin calls. The maximum loss is simply the invested capital, since the ETF's value can't go below zero.
SeekingAlpha.com.
Simpler alternative to options or futures. To obtain similar short-term leverage on the S&P 500, an investor might otherwise use futures or call options on the S&P 500, or on an ETF like SPY. Leveraged ETFs offer a more straightforward, stock-like way to get leverage, without options time decay or strike selection issues. There are even options on SSO and SPUU themselves for those who want higher leverage or hedging strategies, but for many traders a 2x ETF is an easier tool than juggling options contracts. In addition, unlike options, leveraged ETFs do not expire, so a trader can hold the position for days or weeks as needed, keeping in mind the decay issues if held too long.
SeekingAlpha.com.
Quick portfolio adjustments. Short-term leveraged ETFs can be used by portfolio managers or sophisticated investors as a tool to adjust portfolio exposure around certain events. For example, rather than reallocating a long-term portfolio heavily into stocks ahead of a perceived bullish catalyst, an investor could temporarily add SSO or SPUU to quickly ramp up exposure, then remove it after the event.
This avoids disturbing the core long-term portfolio holdings. In effect, SSO/SPUU can act as a temporary overlay to boost equity exposure in the near term.
Hedging short-term risks. Although these two funds are bull-long products, an investor concerned about short-term downside in their stock portfolio could use inverse leveraged ETFs, like ProShares Ultrashort S&P 500, ticker SDS, which is 2x the S&P 500, for hedging during brief periods of expected volatility or downturns. In general, leveraged ETFs are best used as tactical tools to manage short-term market exposures, not as permanent holdings. Lightbulb * key insight: leveraged ETFs such as SSO and SPUU are most effective when used in short bursts, for instance, to exploit a short-lived market momentum or event. They provide convenient, one-stop leverage to the S&P 500, saving traders from the complexity of futures or options and bypassing the need for margin loans. When correctly timed in a strong upward trend or low volatility environment, they can generate magnified gains over a brief period. However, the odds of success drop if they are held too long or through volatile swings. See Section 4 on decay.
Prudent traders use them sparingly and strategically, not as core holdings. SeekingAlpha.com.
6. Risk management strategies for SSO/SPUU. Given the significant risks of holding leveraged ETFs, experienced traders typically employ strict risk management rules when using SSO or SPUU.
Key strategies include: strict time limits. Treat 2x ETFs as short-term instruments.
Avoid prolonged holding periods. Many traders close positions by end of day or within a few days, unless the trade is clearly working in their favor. The longer the holding period, the greater the chance that volatility will eat into returns. See Volatility Decay, Section 4. Both ProShares and Direxan emphasize that these funds are not meant for long-term holding, they are trading tools, not investment vehicles.
WalletInvestor.com, WalletInvestor.com, WalletInvestor.com. Predefine exit points. Plan your exits before entering.
Determine profit targets and stop-loss levels in advance, and stick to them rigorously. For example, a trader might decide to take partial profits after a 20 to 30% gain and close the remainder of the position if it hits, say, a 10% trailing stop. By scaling out, laddering the exits, you lock in gains gradually while still participating in further upside. Conversely, always use stop-loss orders, or mental stop levels, to cap downside, for instance, cutting the position if it falls 10 to 15% from your entry. Because of the potential for swift losses, disciplined stop-loss execution is critical when trading leveraged ETFs. Never allow a losing leveraged trade to run unchecked, as a single severe downswing can wipe out a large portion of capital. ETFDB.com, ETFDB.com, ETFDB.com. Position sizing and portfolio allocation. Limit the portion of your portfolio in leveraged ETFs. A common guideline is to keep each trade small, e.g., risking less than 1 to 2% of account equity, and to limit total exposure to leveraged funds, for example, no more than 5 to 10% of your portfolio in these instruments. This way, even a worst-case loss will not be devastating.
SSO and SPUU are best used as satellite positions, not core holdings. RealMoneyMoves.com, ETFDB.com.
Trend and volatility filters. Use technical and volatility indicators to guide your entries and exits. Because leveraged ETFs perform best in trending, low volatility conditions, traders often enter or hold positions only when the S&P 500's short-term trend is positive, e.g. the index is above key moving averages, and market volatility is low/moderate, e.g. the VIX below a threshold like 20. If the market shifts to a choppy or high volatility regime, it's usually a signal to reduce or close leveraged positions to avoid whipsaw losses. In practice, one might combine a trend-following rule, such as stay in SSO/SPUU only while the S&P trades above its 10-day or 20-day moving average, with a volatility cutoff, e.g. exit if the VIX spikes above a certain level indicating turmoil. By restricting leverage to favorable market regimes, traders attempt to minimize the decay and drawdown risk highlighted earlier.
ETFDB.com, ETFDB.com.
Trailing stops and volatility-based stops. Given the large swings possible with 2x ETFs, trailing stop-loss orders can protect profits and cap downside. For instance, a trader might use an ATR, average true range, based stop, moving it up as the trade becomes profitable, e.g. sell if the price retraces more than 1.5 times ATR from its high, to systematically lock in gains as the fund rises. Such mechanical stop rules help remove emotion from the decision-making process. As an example, ETF traders often use trailing stops that adjust with price moves, ensuring that as SSO/SPUU climbs, an increasing portion of the profit is secured, and the position is sold once the price falls back by a defined amount. Since 2x ETFs can reverse quickly, the discipline of a trailing stop, or periodically raising a manual stop level, helps prevent turning a winning trade into a losing one.
ETFDB.com.
Hedging leveraged positions. Some sophisticated strategies involve pairing a long leveraged ETF with a hedge. For instance, an investor might buy SSO or SPUU for upside exposure but simultaneously buy some protective put options on the S&P 500 or short an equivalent amount of the S&P, or use an inverse ETF.
This can cushion against sudden drops, effectively dialing down the net leverage.
While such techniques can cap the downside, they also reduce the net upside and introduce their own costs. They are generally only used by advanced traders or as part of a broader hedging program. For most investors, a simpler approach is to limit holding period and position size, as noted above, rather than attempting complex hedges.
Bottom line, prudent trading practices are essential when dealing with SSO, SPUU, or any leveraged ETF.
That includes short holding periods, strict exit rules, and careful monitoring. These funds can produce impressive gains when timed right, but they can also generate large losses if trends reverse or volatility surges. Successful usage of leveraged ETFs demands a disciplined, almost mechanical approach to risk management. Define your game plan clearly, and stick to it.
ETFDB.com, ETFDB.com. 7. SSO versus SPUU, Comparison Table. Feature. ProShares Ultra S&P 500, SSO. DirectSyn Daily S&P 500 2x, SPUU. Daily Leverage Objective. Plus 200% of the S&P 500's daily return, 2x, reset at each market close, walletinvestor.com.
Plus 200% of the S&P 500's daily return, 2 times, reset at each market close, walletinvestor.com.
Inception date:
June 20, 2006, portfolioslab.com, first ever 2 times S&P 500 ETF, long track record across cycles. May 27, 2014, portfolioslab.com, launched later with the same mandate, shorter history.
Strategy and portfolio:
Synthetic, derivatives-based, leverage, holds swaps and futures to obtain 2 times exposure, cash and T-bills as collateral, seekingalpha.com, seekingalpha.com.
Does not hold actual S&P 500 stocks directly.
Partially physical replication, holds a basket of S&P 500 equities, 500 plus stocks, and a small index swap position for added leverage, besttf.net, besttf.net.
Expense ratio:
0.89%, 0.87% to 0.90% range in recent disclosures, besttf.net, besttf.net, higher due to extensive use of swaps/futures. 0.6%, besttf.net, besttf.net, among the lowest cost of any 2 times equity ETF.
Assets under management:
$7.8 billion, as of early 2026, tickeron.com, nasdaq.com, by far the largest 2 times S&P ETF, SSO is 30 times the size of SPUU. $0.25 billion, early 2026, tickeron.com, nasdaq.com, much smaller asset base, SSO's AUM is 30 times larger.
Average trading volume:
4 to 5 million shares/day, high liquidity, easy to trade large amounts, swingtradebot.com. 25,000 shares/day, low volume, can have wider spreads and slippage, swingtradebot.com.
Beta versus S&P 500:
2.0, double the market volatility, matches 2 times target, besttf.net. 2.0, very similar volatility profile to SSO, 2 times the market's volatility, besttf.net.
1-year total return asterisk:
plus 24%, portfolioslab.com, portfolioslab.com, versus plus 12% for S&P 500, illustrates successful 2 times outcome. Plus 25%, portfolioslab.com, portfolioslab.com, versus plus 12% for S&P 500, very close to SSO's result.
3-year total return, and asterisk:
plus 32.8%, portfolioslab.com, portfolioslab.com, versus plus 16% for S&P 500, strong rebound after 2020 crash drives high CAGR. Plus 33.3%, portfolioslab.com, portfolioslab.com, versus plus 16% for S&P 500, essentially identical to SSO.
5-year total return, and asterisk:
plus 20.0%, portfolioslab.com, portfolioslab.com, versus plus 10% for S&P 500, reflects bull market compounding and fee drag. Plus 20.6%, portfolioslab.com, portfolioslab.com, versus plus 10% for S&P 500, slightly higher, aided by lower fee.
Largest drawdown:
minus 84.7%, portfolioslab.com, during 2008-09 financial crisis. Minus 59.3%, portfolioslab.com, during March 2020 COVID crash. Use case focus:
favored by active traders, hedge funds, and institutions requiring high liquidity. Favored by cost-sensitive traders making shorter-term trades in smaller size. Recommended use: very short-term trading, momentum chasing, tactical allocation. Not for passive long-term investing, etfdb.com. Very short-term trading, momentum chasing, tactical allocation. Not for passive long-term investing, etfdb.com.
Returns as of early February 2026, multi-year figures are annualized compound rates. 8. Outlook and Analyst Commentary, 2024 to 2026. The recent market environment, 2022 to 2025, has tested leveraged ETFs like SSO and SPUU through both bear and bull phases, offering lessons for their prospective use. Resilience and rebounds: analysts note that during the post-COVID bull market and the tech-led rally in 2023 to 2024, SSO and SPUU prospered. The S&P 500 surged to new highs, crossing 5,200 in late 2024, was accompanied by outsized gains for leveraged ETFs. Zacks Investment Research observed that these funds will continue to be investors' darlings, provided the sentiments remain bullish. In other words, in strong uptrends with low volatility, SSO and SPUU can be effective tools for capturing magnified upside, and demand for such products tends to increase. Indeed, leveraged ETFs as a category saw record inflows in 2024, with total leveraged ETF assets ballooning by $40 billion to over $100 billion in the US, as more traders embraced them. Nasdaq.com, 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 Morningstar.com. Caution from 2025 volatility. However, the tide turned in early 2025. A modest S&P 500 pullback, -3% year-to-date by March, led to disproportionately large losses in many leveraged ETFs, reminding investors of their dangers. Market commentators likened the rush into these products to a risky Squid Game scenario, noting that even as some funds struggled in 2025, many retail traders kept piling in, trying to buy the dip on leverage. This has led to increased scrutiny. Industry experts have warned that novice investors may not fully appreciate the risk of doubling down on volatile markets. As one portfolio manager put it, if people want to gamble on the market, leveraged ETFs facilitate it, but they also come with unique risks, including the possibility of serious financial losses, and even potential structural failures in extreme scenarios. Morningstar.com, Morningstar.com, Morningstar.com. Rising rates and costs. The period from 2022 to 2025 was marked by rising interest rates, which increased the cost of leverage. Higher short-term rates mean higher financing costs for the swaps and futures these ETFs use, which can slightly worsen their performance drag. While not as immediately dramatic as volatility effects, a persistently higher rate environment in 2024 to 2025 contributed to increased expense ratios. SSO's fee ticked up from 0.89% to 0.9% in recent disclosures, and could reduce long-run returns for leveraged funds. This is another reason analysts in 2024 to 2026 have been cautioning that expected forward returns for leveraged ETFs may be lower than past averages if interest rates remain high, since a portion of gross returns goes to financing costs. BestTF.net, BestTF.net. Regulatory and expert warnings. The popularity of products like SSO and SPUU has prompted reminders from financial advisors and regulators. The consensus outlook is that these ETFs are best left to traders who can closely monitor them. Morningstar's team reported in 2025 that, although usage of leveraged and inverse ETFs hit record levels, many of these funds are struggling and are unsuitable for long-term investors due to volatility decay and compounding risk. ETF experts often emphasize that leveraged ETFs entice risky bets on short-term market swings rather than serving traditional investment goals. Both ProShares and DirectSen issue alerts in their prospectuses about the effects of daily resetting and warn that investors should monitor their holdings daily, or even intraday in volatile markets, and should not rely on these for more than interim periods. Morningstar.com, Morningstar.com, Morningstar.com. Continued innovation. Despite these warnings, the trend has been toward more leveraged products and high investor interest. By late 2025, providers were launching an array of new leveraged ETFs, including single-stock 2x and 3x products, attempting to meet demand. This suggests that SSO and SPUU will likely continue to exist as part of the trading toolkit. Analysts expect that as long as there are strong market trends, either up or down, traders will seek out these instruments. But they stress that education is key. Understanding how SSO and SPUU function is crucial. One Seeking Alpha analyst succinctly summarized SSO as a tool that soars in sustained uptrends but can erode quickly in volatility, best used by tactical investors with a clear plan. Morningstar.com, Morningstar.com, SeekingAlpha.com. Conclusion, key takeaway, SSO and SPUU offer two paths to the same goal: double the daily performance of the S&P 500. SSO provides this with unparalleled liquidity and a long track record, at a somewhat higher cost. SPUU offers a fee advantage and similar performance, but in a smaller, less liquid package. Both will amplify the S&P 500's moves, delivering outsized gains in bull runs and equally outsized losses in downturns. Because of the powerful forces of volatility decay and high fees, neither is suited to long-term holding for typical investors. Their value lies in short-term strategic moves, riding a strong market wave or adjusting exposure for a brief period. When used judiciously, with strict risk controls, SSO and SPUU can be effective tools for experienced market participants. But without such discipline, their leverage can just as easily work against investors. In the words of one finance author, leveraged ETFs work for disciplined, short-term traders who understand the math, but can destroy wealth for everyone else. Investors considering SSO or SPUU should be sure they fully appreciate the risks, stay vigilant, and have an exit strategy in place so that the power of 2 times leverage becomes a friend, not a foe.
ETFDB.com, RealMoneyMoves.com, RealMoneyMoves.com.
Sources: Volatility drivers in gold, silver, platinum, and copper, accuracy of key claims and analysis.
Introduction.
Recent market action in gold, silver, platinum, and copper has underscored their extreme price swings, especially during the 2025 to 2026 metals melt-up. An analysis was compiled attributing this volatility to 5 core drivers: 1. Industrial demand shocks, 2. Monetary and macroeconomic forces, 3. Structural supply shortages, 4. Paper/derivatives market dynamics, and 5. Geopolitical and trade policy shocks. Additionally, each metal's unique character, gold's status as a monetary asset, silver's dual monetary industrial nature, platinum's reliance on autocatalysts and concentrated supply, and copper's pure industrial role, was cited as shaping its volatility profile. Finally, several risk mitigation strategies, technical filters, scaling positions, hedging, etc., were proposed. This report evaluates the accuracy of the key claims from that analysis using credible industry sources, LPL Research, Money Metals Exchange, World Bank, Sprott, CPM Group, Mining Weekly, etc., and organizes the findings by the 5 core drivers. We then review each metal's volatility characteristics, and conclude with a section on the risk mitigation strategies, assessing their rationale. The goal is to distinguish which claims are well supported by data and expert commentary and to clarify any nuances or discrepancies. A summary table of major claims and their accuracy is also provided for quick reference.
Core drivers of metal price volatility, verification of claims. 1. Industrial demand shocks and cyclical booms/busts.
Claim: industrial usage creates cyclical, boom-bust demand, especially for silver, platinum, and copper. This claim is strongly supported by market data and analyses. In 2025, all 3 of these metals experienced surging prices largely due to booming industrial demand in specific sectors, followed by periods of sharp corrections, a textbook example of whiplash volatility caused by demand shocks.
Silver surge: silver posted an extraordinary almost equal to 148% price increase in 2025, its best annual performance since 1979.
Industry reports confirm this parabolic rise was driven by booming industrial demand, especially for solar panels and electronics, combined with structural supply tightness. For instance, Sharecon Research noted that silver hit $84 per oz in 2025, up 148%, fueled by tight global supply amid the green energy transition. Similarly, LPL Financial observed that silver delivered an even more extraordinary performance, posting a 148% price return in 2025, far outpacing gold's gains. These data validate the claim that a surge in industrial consumption, e.g. record photovoltaic/solar installations and electronics demand, alongside a supply squeeze led to explosive silver volatility in 2025.
LPL.com, Research.s, Recon.com, Research.s, Recon.com, Research.s, Recon.com.
Copper's rally: LPL also reports that copper climbed 41% in 2025, following a volatile path shaped by tariff expectations. This aligns with the claim that trade-driven industrial demand shocks can whipsaw prices. Heightened expectations of U.S. tariffs on imported copper products, coupled with tight global inventories, prompted manufacturers and traders to stockpile copper, driving prices sharply higher. Once policy signals changed, e.g. exemptions for refined copper, some of that rally faded, illustrating how when factories and policymakers pump the brakes, demand collapses and prices can quickly reverse. Nonetheless, the boom in electrification and electric vehicle (EV) production provided a strong underlying demand trend. S&P Global projected copper demand to rise 50% by 2040 due to EVs, AI data centers, and grid expansion, creating a secular uptrend. But in the short run, policy shocks, like the August 2025 50% U.S. tariff on semi-finished copper goods, caused immediate volatility that fundamentals couldn't offset. LPL.com, CMEgroup.com, CMEgroup.com, CMEgroup.com. Platinum and palladium spikes. The analysis claimed platinum and palladium saw triple-digit gains from auto catalyst and green tech demand. This is partly accurate. Platinum prices did skyrocket by over 100% in 2025. LPL documents a plus 127% annual gain for platinum, and Money Metals independently reports platinum has surged by 92% in 2025, the slight difference likely due to date of measurement. Palladium, however, rose around 65 to 78%, not quite triple-digit. LPL noted plus 78% and Money Metals reports plus 65%. So, platinum's gain was indeed in the triple digits, whereas palladium's, while very large, was high double digits. Both of these platinum group metals, PGMs, were propelled by industrial demand surges, robust needs for autocatalytic converters, as global car production recovered and emission standards tightened, and growing use in green technologies, like hydrogen fuel cells for platinum. The industrial boom for autos and clean tech in 2025 created a spike in PGM consumption. Crucially, this demand shock occurred against the backdrop of constrained PGM supplies, discussed further under supply shortages, magnifying the price response. LPL.com, MoneyMetals.com, 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 Sprott.com. Overall, evidence confirms that cyclical industrial demand swings are a core source of volatility for these metals. As the analysis suggested, booming demand from sectors like electric vehicles, renewable energy, solar, electronics, and automotive catalysts led to rapid price appreciation, while any subsequent cooling in those sectors, or policy changes like tariffs, triggered abrupt corrections. This boom-or-bust pattern is indeed characteristic of industrial commodities. When governments stimulate green tech or auto sales, demand spikes and prices soar. When industrial activity slows or a supply glut emerges, prices can collapse. The 2025 data on silver, copper, and PGMs strongly validates this driver of volatility. 2. Monetary and macroeconomic forces. The analysis highlighted that gold is primarily a monetary metal, with only 10 to 15% of its demand coming from industry, and that its price volatility is governed by macrofinancial forces, real interest rates, currency values, central bank buying, geopolitical risk. These claims are well-founded. Gold's non-industrial demand dominance. It is accurate that only around 10%, or less, of gold demand is for true industrial uses, with the vast majority stemming from investment, jewelry, which often serves as a form of savings, and central bank reserves. For example, gold's use in technology and electronics is typically in the high single digits as a share of total demand. A 2025 market review confirmed that jewelry was about half of gold demand, investment 35 or 40%, and technology only 8%. This aligns with the claim that 10 to 15% of gold demand is industrial, the rest is investment, jewelry as savings, and central bank buying. Gold's pricing is therefore less tied to business cycles for fabrication and more tied to its role as a financial asset and store of value. Goldmarket.fr, Goldmarket.fr. Real interest rates and currency as key drivers. Multiple sources affirm that real interest rates are the single most influential driver of gold prices over time. Gold is considered a zero-yield asset, so when real yields, interest rates minus inflation, fall, gold becomes more attractive, and its price tends to rise, and vice versa. Analysts have found a strong inverse correlation. For example, a 1% drop in 10-year real treasury yields historically corresponds to an 8 to 15% rise in gold. The World Bank noted that gold's largest bull runs, e.g., 2020 to 2021, 2025, coincided with periods of negative or falling real rates and high uncertainty. Likewise, the value of the US dollar is inversely correlated with gold. A weaker dollar makes gold cheaper for global investors, often boosting demand, whereas a strong dollar pressures gold down. 2025 illustrated this dynamic. despite rising interest rates early in the year, real interest rates turned lower as inflation remained elevated and the Federal Reserve began cutting rates later in the year, which propelled gold upward. A World Bank blog in November 2025 observed that gold's 42% YTD rise was helped by a weaker US dollar and US monetary easing, along with safe haven interest due to geopolitical tensions. The analysis's emphasis on real rates and dollar strength/weakness as gold drivers is firmly supported by economic research and recent market behavior. Discovery ert.com.o, blogs.worldbank.org, blogs.worldbank.org, blogs.worldbank.org. Central bank accumulation and geopolitical risk, these are indeed critical macro drivers for gold. Central bank gold purchases hit record levels in 2022 to 2025, providing a significant source of demand support. In 2025, central banks remained net buyers of gold, over 1,000 tons for a second consecutive year, as they diversified reserves away from the US dollar, a trend spurred by geopolitical considerations. This official sector demand created unpredictable demand waves, as the analysis noted, contributing to gold's rally. For example, China, Turkey, and other emerging markets were notable gold buyers, aiming to hedge currency and geopolitical risks. Geopolitical turmoil, war, trade conflicts, sanctions also reliably boost safe haven demand. The World Bank reported gold prices surged to record highs in October 2025 amid rising geopolitical tensions and strong investor demand, with safe haven flows expecting to keep prices elevated. In short, monetary and geopolitical factors have indeed been primary triggers for gold's volatility. When real yields drop or global risks rise, gold often spikes. When interest rates or the dollar rise, gold can rapidly sell off. These relationships are core to understanding gold's behavior, as reflected in both academic studies and 2025's real-world market data. Blogs.worldbank.org, blogs.worldbank.org, discoveryert.com.o, discoveryert.com.o. In summary, gold's volatility is rooted in its monetary nature. Its minimal industrial use means sentiment and macro variables reign supreme in price formation. The analysis correctly identified real interest rates, and by extension inflation expectations, currency movements, central bank behavior, and geopolitical risk as pivotal causes of gold's volatile swings. The 65% surge in gold during 2025, to an all-time high around $4,550 per oz, was indeed driven by this confluence of macro factors: unprecedented central bank buying, concerns over inflation and U.S. fiscal policy, and global geopolitical strains. Discoveryert.com.o, blogs.worldbank.org, research.s, recon.com. 3. Structural supply shortages amplifying price swings. The analysis highlights that all four metals have long-cycle supply constraints, new mines take years to develop, or grades are declining, and environmental/regulatory hurdles are high, resulting in inelastic supply that amplifies price swings when demand changes. This assessment is accurate, and was notably evident in the 2025 to 2026 period when demand spikes collided with tight supplies. Long lead times and declining supply growth, industry data confirmed that bringing new mining capacity online for these metals is a slow, decade-long process. For example, a CME Group Copper Outlook noted that mine development takes 7 to 10 years, during which time global demand can change significantly. Meanwhile, existing deposits are yielding lower grades, copper or grades less than 0.6%, roughly half of levels 25 years ago, as high-quality reserves are depleted. LPL research pointed out that chronic underinvestment in mining and production outages in recent years have constrained supply across both precious and base metals. In other words, supply growth for gold, silver, platinum, and copper has been unable to keep pace with surging demand, especially given the lag times and challenges, permitting, labor, energy, inherent in mining. This creates a structurally tight market. CMEgroup.com, LPL.com. Multi-year deficits in key markets. The notion of structural deficits is supported by market data. The silver market, for instance, has been in deficit for 5 consecutive years, 2021 to 2025, with cumulative shortfalls of 820 million ounces over that period. Mining Weekly reported that 2025 was set to be the 5th straight year of deficit for silver, contributing to one of the most volatile years in decades. Platinum has a similar story. The World Platinum Investment Council, WPSC, recorded significant platinum shortfalls of 0.901 million ounces each year from 2023 to 2025. Sprott's May 2025 report likewise emphasized that platinum was facing a third consecutive year of major supply deficits, risking the depletion of above-ground inventories within a few years. These persistent shortfalls mean that any increase in demand, or disruption of supply, quickly results in inventory draws and sharp price increases, since production cannot be ramped up quickly. For example, even before 2025's big rally, platinum's supply was so constrained that above-ground stocks projected to dwindle to just 2.5 MAs in 2025, with no new mines in sight. This tightness set the stage for 2025's steep price climb when demand unexpectedly jumped. Similarly, the copper market had global exchange stockpiles covering only 3 weeks of consumption entering late 2025. In such tight markets, small demand shifts cause outsized moves. MiningWeekly.com, MoneyMetals.com, Sprott.com, CMEGroup.com. Inelastic supply amplifies volatility. The analysis is correct that structural shortages amplify price volatility. When demand spikes in an inelastic supply environment, prices don't just rise, they melt up. LPL explicitly listed structural supply shortages as a key driver behind the 2025 metals rally, noting that production outages, geopolitical supply disruptions, and slow project pipelines created a backdrop where rising demand, from electrification, green energy, etc., led to aggressive price moves. Market participants are keenly aware of this dynamic. A commodities strategist at CME emphasized that in copper's case, tightness can amplify volatility, advising traders to monitor mining output and disruption news closely. Real examples abound. South Africa's power grid issues and mine strikes in 2025 curtailed platinum supply, contributing to volatility in copper. Drought and protests in South American mines have caused sudden supply drops, spiking prices. Across all four metals, declining mine productivity, limited new discoveries, and long permitting timelines mean that supply reacts sluggishly to demand changes, making prices more sensitive to short-term imbalances. Thus, the claim that structural supply issues are a major volatility driver is well supported. When demand rises or even when investors fear future shortages, prices jump, as seen with silver and copper flowing into exchange warehouses amid 2025's tariff and critical mineral policy rumors. Conversely, news of potential supply relief, e.g. a large new deposit or lifting of a mining ban, can quickly depress prices. The inherent inelasticity on the supply side is a fundamental reason these commodity markets experience such dramatic spikes and slumps. LPL.com, CMEGroup.com, MoneyMetals.com, CMEGroup.com, Sprott.com, MiningWeekly.com. 4. Paper derivatives markets amplifying volatility. The analysis asserted that paper markets, futures, options, and ETFs, layered on top of physical commodity markets significantly amplify volatility, causing clustering of volatility, sudden squeezes, and flash crashes, even though these financial instruments are not the root cause of volatility. This claim is strongly supported by market structure research. Trading volume domination by paper versus physical. It is well documented that the vast majority of trading in gold, silver, platinum, and copper occurs via financial derivatives rather than through physical metal transactions. A report by FGA Partners, January 2026, emphasizes that in precious metals, unchecked leverage and aggressive short positioning can distort reality, noting that the vast majority of trading occurs not in physical bars or coins but in paper derivatives. Leveraged futures allow traders to control large quantities of metal with relatively little capital, magnifying each price move and decoupling short-term price action from underlying physical supply/demand fundamentals. For instance, on COMEX, tens or hundreds of ounces of paper silver may be traded for every ounce of actual physical silver in vaults, a ratio that grows during speculative frenzies. FGAPartners.com. Leverage, short selling, and volatility. Because of this structure, small triggers can lead to outsized price swings as trading positions are adjusted. When many traders are caught wrong-footed, e.g. heavily short and the price rises, they must cover positions, leading to cascades higher, the classic short squeeze. Conversely, rapid sell-offs can be exacerbated by margin calls and algorithmic stop-loss orders. The analysis referenced fast squeezes and flash crashes, which have precedent, e.g., the January 2026 precious metals mini crash saw silver plunge 31% in 2 days before rebounding as a wave of futures selling hit in a liquid market. Bloomberg reported that this whipsaw was amplified by speculative momentum and thinner over-the-counter trading. Silver has always been subject to more violent price swings than gold, due to its smaller market and lower liquidity. In other words, leveraged paper trading in a relatively thin market creates a feedback loop. High volatility prompts market makers to widen spreads or reduce liquidity, which further increases volatility.
Finance.yahoo.com, finance.yahoo.com, finance.yahoo.com.
Volatility clustering in metals. The notion that volatility comes in cycles or clusters is a well-known feature of financial markets, and metals are no exception. Money Metals analyst Jesse Colombo noted that volatility in financial markets is highly cyclical, with long periods of quiet in gold/silver often leading to explosive volatility. He illustrates how low Bollinger Bandwidth, a proxy for low volatility, was followed by sudden breakouts in gold, silver, platinum, and mining stocks in late 2025, driven largely by shifts in speculative positioning. This supports the analysis's point that paper markets don't generate the initial catalyst, which could be a fundamental event, but they greatly magnify the magnitude and speed of the move. For example, in April 2023, a relatively minor rumor about silver import tariffs led to a huge spike, as algorithms and futures traders piled on, far overshooting any logical move from physical shortage alone. The presence of high-frequency trading and large funds rapidly reallocating via futures/ETFs means that markets react instantly and often dramatically to news, overshooting fundamentals in the short term. MoneyMetals.com, 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 FGAPartners.com, FGAPartners.com. In summary, the analysis is correct that the structure of derivatives markets adds significant volatility to metals. Futures and ETF flows act as an accelerant. They increase liquidity in calm times, but in turbulent times they amplify swings well beyond what physical buying or selling would achieve. As one report put it, prices shaped by leverage can be volatile and counterintuitive. Those supported by fundamental physical demand are far more stable. The 2025 melt-up was aided by record ETF inflows, e.g., gold ETFs saw an $89 billion influx, boosting holdings to all-time highs, illustrating how investor capital flows in paper instruments drove prices higher, in tandem with fundamental trends. The core message stands: derivative markets significantly magnify short-term volatility in gold, silver, platinum, and copper.
FGAPartners.com, LPL.com.
5. Geopolitical and trade policy shocks. Claim: tariffs, sanctions, and geopolitical tensions create sudden price gap-ups or gap-downs that physical supply cannot quickly adjust to. This is accurate, as 2025 provided vivid examples across these metals of policy and geopolitical events causing abrupt price moves. Trade policy, tariff/export controls. Both LPL research and news sources note that anticipation of tariffs or export restrictions directly impacted metals prices in 2025. For instance, LPL highlighted that China recently imposed stricter export controls on silver, and that the White House's tariff moves on copper products caught markets off guard. In fact, the prospect of U.S. tariffs on metals prompted frantic repositioning. The Money Metals PGM analysis described how rumors of tariffs led to large movements of platinum and palladium into U.S. exchange warehouses, contributing to volatility, until it became clear that refined PGMs would be exempt. Similarly, Mining Weekly reported that silver's record high of $54.50 per oz in October 2025 was fueled in part by unprecedented deliveries into CME vaults amid U.S. tariff concerns and the U.S. government's designation of silver as a strategic critical mineral, which spooked the market. Once these policy concerns eased, some of the froth came out of prices, illustrating the gap-up/gap-down effect. Copper also saw rapid swings on trade news. The imposition of a 50% tariff on some copper imports in August 2025 temporarily drove U.S. copper premiums to record levels, while later talk of broadening or rescinding these measures whipsawed prices. These moves happened faster than mines or consumers could practically respond, a clear example of how financial markets instantly reprice metals on policy news. LPL.com, MoneyMetals.com, MoneyMetals.com, MiningWeekly.com, CMEGroup.com. Geopolitical shocks. Metals, especially gold, react sharply to war, conflict, and sanctions. The analysis correctly noted that gold responds to war risk, sanctions, and central bank diversification. When Russia invaded Ukraine in 2022 or when conflicts flared in 2025, gold saw safe haven buying that pushed prices up quickly. The World Bank, October 2025, explicitly cites heightened geopolitical tensions as a key factor behind record gold and silver prices, alongside investor safe haven demand. These tensions included war concerns, e.g., in Eastern Europe and elsewhere, and even central banks diversifying reserves to reduce reliance on the US dollar due to geopolitical trust issues. Because such events are unpredictable and physical supply cannot be rapidly increased, prices jump in response to perceived risk. A common adage is that gold is the crisis commodity, which bears out in data. Gold's largest one-day moves often coincide with geopolitical crises or surprise central bank actions. Industrial metals can also be hit by geopolitics, e.g., sanctions on Russian nickel and palladium in 2022 caused price chaos, and any threat to major copper mining regions, like Chile/Peru unrest, leads to immediate price rallies. blogs.worldbank.org, blogs.worldbank.org, lpl.com, blogs.worldbank.org. In essence, the analysis is validated. Metals markets in 2025 to 2026 repeatedly showed large gap moves linked to geopolitical or policy announcements. These exogenous shocks can send prices soaring or plummeting overnight, long before any physical supply response, such as increased mining or strategic stockpile release, can materialize. It underscores why metals are often considered barometers of global risk. They respond swiftly to news of war or policy changes. As LPL concluded, easing tensions or clarifications in trade policy can diminish the safe haven appeal currently embedded in precious metals, potentially reversing rallies. Until such clarity arrives, however, uncertainty premiums can keep volatility high. LPL.com. Having verified the 5 core drivers, we can confidently say the original analysis correctly identified the key forces behind gold, silver, platinum, and copper volatility. Industrial demand cycles, macrofinancial, monetary, conditions, structural supply inelasticity, derivative market leverage, and geopolitical/trade shocks all indeed contribute to volatility, often in reinforcing ways.
In 2025, these factors converged, yielding unprecedented price moves across all 4 metals.
The next section examines how each metal's unique characteristics lead to differences in how they react to these common drivers. Metal-specific volatility profiles: gold versus silver versus platinum versus copper. Each of the 4 metals has a distinct supply-demand profile and market role, causing them to react somewhat differently to the core drivers. Gold, monetary asset volatility. Gold stands apart as primarily a monetary, non-industrial, asset, which makes its price more sensitive to financial conditions and investor sentiment. Only a small fraction, roughly 8 to 12%, of gold's yearly demand comes from technology/industry, meaning gold's value is driven by investment demand, jewelry, often a form of savings, especially in Asia, and central bank reserves. This gives gold a safe haven character. It tends to spike in times of economic or geopolitical crisis and to suffer when real interest rates rise or the dollar strengthens. As noted, real yields are a dominant driver. When inflation-adjusted rates are low or negative, holding gold, which yields nothing, becomes more attractive. Conversely, when real rates in the US dollar climb, gold often falls hard despite unchanged physical demand, because investors rotate out. For example, in 2025, despite modest changes in jewelry demand, gold's price soared by 60 to 65% largely due to macroeconomic forces, Fed policy pivot to rate cuts, record central bank buying, and inflation fears. Gold's volatility, therefore, is sentiment-driven to a large extent. Unpredictable shifts in monetary policy or risk sentiment can lead to abrupt price moves, in both directions, that are difficult to anchor to any immediate supply or industrial usage factors. Goldmarket.fr, Goldmarket.fr, Discovery, ERT.com.o, LPL.com, Research.s, Recon.com, Research.s, Recon.com. research.s, recon.com, research.s, recon.com.